What does it mean to be a smart investor? This is something that a lot of people ask, especially millennials who are about to inherit a large sum of money. Being a smart investor doesn't mean that you can make a lot of money in a short period of time. It means that you are able to use available resources to make a steady investment, diversify your portfolio and accumulate wealth over time. Before we begin, if you don't subscribe yet, please subscribe to our channel, and hit the bell icon to get notified of our new videos. There are a few things that you need to do in order to be a smart investor. The first is to start investing early. The sooner you start, the better. You should also be consistent with your investment. This means investing a specific amount each month or quarter. Another important thing to do is to diversify your portfolio. This means having different investments in different areas. This will help you to avoid extreme financial losses. In the case of a volatile market, another important step to take as a financial investor is to build a risk appetite. This means knowing your financial loss threshold and your tolerance for volatile markets. Finally, you should educate yourself and be patient. Do not be in a rush to dive into the stock market and make profits. Doing so carelessly would be like throwing your money down the drain. If you make it a habit to learn something new about investing every day, it'll pay off in the long run. Warren Buffett is one of the smartest investors in the world. His investment strategy has changed over the years to focus on acquiring stocks and companies that he believes are well managed and undervalued. He typically holds on to these investments indefinitely. This has made him one of the richest men in the world. If you want to be a smart investor like Warren Buffett, there are a few things you need to do. The few key strategies that smart investors use in order to make the most of their money. The first and arguably most important strategy is to have a plan and stick to it. This means knowing exactly why you are investing in a particular company or stock before you spend any money. Once you have made your purchase, it is also important to stick to your original plan in order to maximize your chances for success. This means not putting all of your eggs in one basket, so to speak. By diversifying, you are essentially hedging your bets and increasing your chances of seeing a return on your investment. It is important to stay up to date on the latest news and developments in the world of finance. By keeping abreast of the latest news, you will be better equipped to make informed decisions about your investments. Many investors try to time the market, but this can be difficult to do consistently. Another strategy is to not time the market. This means not chasing performance. Even the most successful managers occasionally underperform to generate profits. By timing the market, investors must be able to read the market at an almost psychic level. This strategy can be difficult, but it can be helpful to remember that even the best investors sometimes have losing streaks. By not timing the market, investors can avoid the temptation to sell when the market is down. The third strategy is to be more conservative and avoid doubling down. This means not throwing more money at a failing investment. If your research is incorrect and the stock fails instead of rising, you've made a mistake. Doubling down on a stock in the hopes of recouping your losses is akin to wasting more of your money. It's a sunk cost fallacy. Although doubling down occasionally pays off, it's more of a lottery technique than an investing strategy. There is an investment strategy that basically revolves around going against the current. It's called contrarian investing and it's famously associated with Warren Buffett's. This means being fearful when others are greedy and greedy when others are fearful. Build a risk appetite. In the case of a volatile market, another important step to take as a financial investor is to build a risk appetite. Yes, we know we just mentioned diversifying your investments is to manage your risk. But every investment itself is a risk, and you can't be an investor without taking some risks. Let's just clarify one thing, though. You should measure the level of risk you are willing to take. Knowing your financial loss threshold and your tolerance for volatile markets is crucial as it'll help you to secure your financial future. That's all for today. If you like this video, please give it a thumbs up. And if you want to hear more videos from our channel, subscribe and make sure to turn on the bell icon.